En los próximos minutos vamos a centrarnos en la estrategia multiactivos que mantiene Alliance Bernstein y vamos a hablar con su especialista multiactivos, es Edward Williams. Edward, thank you so much for having us a few minutes.
Thank you very much for having me.
Edward, year to date has been a very challenging period for almost every asset class. Could you share your thoughts on what the key drivers of this have been and what it means for multi-asset investors?
Yes, I mean that's correct. As you mentioned, the first part of this year has been incredibly painful for most areas of capital markets, perhaps maybe with the exception of commodity or energy-related exposure. And I think this market action has really been driven by a few key dynamics. The first, and in my opinion, the most prominent, is inflation and what this could mean in terms of central bank policy. So, for example, in the US, inflation's risen to levels that we haven't seen for 40 years. And this has really been driven by a combination of both supply-side challenges that arose from the pandemic, but also soaring energy prices that have really been compounded by the Russian invasion of Ukraine. So to combat this, we've seen central banks across the world have to try to raise interest rates to try and avoid this inflation spiraling out of control. The knock-on impact of this really is that markets begin to reassess current valuation levels. They price in tighter credit conditions, slowing growth, and the potential risk of recession. And thus, we've seen markets react negatively to this. I would say the second factor, I touched on this briefly, but is the Russian invasion of Ukraine. I would say outside of the clear humanitarian impacts, the war has also led to market volatility. And we've seen this as investors both digest the knock-on impact on trade and growth for countries in Europe in particular, but also the continued upside pressure on commodity prices. I would say the third factor would be the strict COVID-related lockdowns that we've seen in China. As we know, China is one of the core drivers of global trade and economic activity. And while we're seeing some encouraging signs that the situation there is improving, the majority of the country has been under these sort of strict lockdowns for the whole of this year so far in an attempt to curb cases. So a combination of these three dynamics has led to one of the worst starts to the year for financial markets on record. And even with quite a good rally in equity markets last week, equities are still down close to 20% this year. Credit's down around 15% this year, and government bonds are down around the same. So what this means for us as multi-asset investors is that traditional diversification that we've come to enjoy has really not been in place so far this year. We've seen correlations on these core asset groups start to rise. So while moving forward, I say we do expect this kind of diversification benefit to reassert itself. What this period has done is highlight the need for us to use an expanded toolkit and look across the broadest possible set of opportunities across the capital market universe.
Edward, in this picture of what's happening in the markets now, you mentioned that markets have reacted to fears of a recession. Do you think that this recession is a likely outcome in the near term?
So I would say that the risk of recession is certainly more pronounced today than it was at the start of this year. In recent weeks, we've seen equity markets begin to price in these risks. We saw the S&P 500 index enter bear market territory just a couple of weeks ago, which tends to be a fairly reliable indicator for a recession. We also heard from the chair of the US Federal Reserve, Jay Powell. He came out last week and said that achieving a soft landing could be very challenging. And this really is his most explicit acknowledgement to date that the aggressive hiking cycle could potentially tip the US economy into recession. I would say that said, I think there are still plenty of reasons to be optimistic, and I would say a full-blown recession is certainly not inevitable, and indeed it's not ours or the market's base case either. So if we look at measures of economic activity across Europe and the US, while we are seeing signs of a moderation, it still remains very much in healthy territory. And the same is true when you look at something like corporate earnings. These surprised to the upside in the first quarter, and they're also expected to continue to grow at a very good rate for the remainder of this year. So alongside this, I would say while inflation does remain red hot across much of the global economy. There are some encouraging signs that this is starting to cool. In areas like durable goods, for instance, which really was one of the kind of the key drivers of post-pandemic inflation. So to the extent we see a continuation of this and perhaps maybe some easing in commodity-related inflation, this could help to reduce the need for central banks to take such an aggressive stance towards their monetary policy.
And you talked about the heightened market volatility and rising inflationary pressures. How do you think about managing these risks within your multi-asset income strategy?
So at an overall level, we've been maintaining an underweight, I would say, in aggregate to risk assets, and that's been the case since the start of this year. Given the elevated level of volatility within markets and also some of the uncertainties and the headline risks that I mentioned earlier. So this underweight really is expressed across both our equity and our credit allocations. But we have moderated this slightly on the credit side, as we think that a reasonable amount of recession risk has already been priced into yields, and the fundamental backdrop for credit still remains fairly robust. Alongside this, I would say, after a period of being underweight duration within the portfolio, we have added back recently. There's been a significant amount of volatility within rate markets in recent months, really driven by these inflationary concerns. But in our view, the current levels that yields have reached have largely priced in these risks. In addition to this, if we are to see a recession, which I mentioned isn't our base case, or any kind of further escalation in geopolitical tensions, an allocation to duration or government bonds should help to offer some downside mitigation to the portfolio. And I guess one other thing to add on more of a tactical basis, this is smaller in size, but we have been adding to some commodity-related equities, which really act as a more distinct and explicit inflation hedge, and to, I guess, offer the portfolio a bit more protection should we see some of these inflationary dynamics persist for the remainder of the year.
With diversification as more challenging year to date, what else do multi-asset investors have in their toolbox?
Sure. So I think for us as multi-asset investors, it's important not to just think about asset allocation from a top-down perspective, but rather consider being flexible within asset classes themselves. So, for instance, I mentioned that within our multi-asset income strategies, we've been underweight equities in general. But what we've also been doing is within that equity allocation, we've been tilting towards more defensive areas of the market. So this is things like low volatility equities and high dividend equities. So both of these, I would say, sub-asset classes have delivered some very good outperformance relative to the broad equity market this year. Alongside this, I guess where possible, we continue to advocate leaning into active underlying exposures, both within our equity allocations and within our fixed income allocations as well. And we believe, I guess, as we move into an environment where broad market returns may be slightly more challenged, the additional alpha generation that we can get from these types of strategies will become an increasingly important component of overall total returns.
Edward, as we talked at the beginning of this interview, a lot has happened in markets over the first 6 months of the year. Where do we go from here now?
So I think in the near term, I do expect some of this market volatility to persist as we continue along the path of monetary policy normalization and as we shift perhaps into a new business cycle regime. That said, I think longer term forward returns are now looking much more attractive than they have been in recent history. So the broad-based sell-off that we've seen across pretty much every area of capital markets has meant that most asset classes are now trading very, very close to the kind of the cheaper end of their 10-year ranges. So if we take something like US equities as an example, the average 12-month forward return coming out of a bear market has been somewhere between 20 and 25% on average. And the same is true on the fixed income side as well. Broadly speaking, something like yield to worst would be a very good indicator of 12-month forward returns. And we're now seeing yields in excess of 8% on things like high yield credit and emerging market debt. And we're even getting yields of about 4% on investment grade credit, which is almost double what it was at the beginning of this year. So maybe if I just kind of round this off and as we move ahead, I think that multi-asset strategies are very well positioned to benefit from what is a very fast-paced and evolving market environment. I think to the extent we see inflation expectations begin to normalize, the risk assets that we hold within the portfolio should outperform as some of these sort of monetary policy fears begin to ease. But to the extent we see further market volatility, both the diversification and the active management within our multi-asset portfolios should help to manage downside risks further from here.
So Edward Williams, multi-asset specialist in Alliance Bernstein, thank you so much. It's been a pleasure.
Thank you very much.